the gold and silver coming out of the London vault, which was your first thesis. I think that's much less pronounced, but silver is a really, almost shocking depletion of the supply there. That works out to roughly a 32% annualized return for gold and 33% for silver, which is, fantastic.
Gold and silver are ripping higher and Bitcoin's gone down significantly. It's
There's some real reasons to like these trades going forward. We're at all-time highs, and I believe inflation adjusted highs for gold as well. All right, Daniel, welcome back to another episode of Investing Counterpoint. Great to have you. We haven't done this in a while. We've been recording our own videos because it's very hard to organize our schedules so that we can do this, but it's always fun when we do it.
Yes, and we should be more disciplined about it because there's so many interesting events and so many unusual kind of correlations and relationships.
Yeah, and so we've both done a couple of videos. I've done a couple on stress testing. You did one on AI, but what I wanted to do today is I wanted to start off. I don't know if you invested in gold and silver back when we started to talk about it. I know that I did, and it's been really a successful investment. And we started this gold silver investing talk back in November 4th of 2022. And it was a long time ago. So what I wanted to do is actually, I did this just the other day, is I said, first I wanted to find out when we actually did go back and start that, recommendation with our first videos, or not necessarily a recommendation. We don't really make recommendations, but when we started talking about the gold and silver coming out of the London vault, which was your first thesis. I mean, actually, to be fair, that was your kind of thesis. You noticed something and then we started talking about it and went from there. So you noticed that there was a lot of action that was unusual in the vault. And so we picked up on that and we did a couple more videos. And so I'm going to bring something up on the screen, which, you'll appreciate, I think, because it's, really your chart here.
Yeah, and then we talked about it always in the context of risk management, and it's been, a very good hedge. We'll see if it's going forward. We'll run some stress tests, but yeah, go ahead.
Yeah, I mean, exactly. What you see here, this is the data that we showed back when we were doing the videos earlier. And if you remember, we were doing the videos in 2022 going into 2023, and it was around here. So what you see, I wish I could get rid of the pop-ups there, but you see it coming. You see gold and silver, but silver especially being rapidly depleted as we came into 2023 here, which is about right here. And this is what you notice, especially in silver. And this trend kind of continued in both of the precious metals here up until the beginning of this year. And we've started to see an increase in the supply in the vaults. Now, this is still way below the historic levels, especially for silver. I mean, gold, I think that's much less pronounced, but silver is a really, almost shocking depletion of the supply there, of the storage of that metal. And so what we've seen is that silver has gone from, I believe the price was 1946. When we started this, it's $45 today. Gold was $16.81 per ounce back when we started talking about this in November 4th, 2022. And today it's $3,753. That works out to roughly a 32% annualized return for gold and 33% for silver, which is, fantastic. Something like Bitcoin has done better on an annualized basis, returning about 70%. It's really been hard to
The last
match
couple of
it.
days, we've seen very interesting action in the market where gold and silver are ripping higher and Bitcoin's gone down significantly. It's very kind of.
It is unusual. And I think if you're looking for something stable too, you also have to take into account the volatility. I mean, I've talked about volatility of Bitcoin. I mean, some people just look at the top line and want that return, and that's great. That's, maybe that's your Bitcoin game. But if you look at something that has around a 20% volatility with gold and silver, I didn't do the calculation on exactly what the volatility of those metals is versus on 70% for Bitcoin. You have a 1.5 times return to volatility ratio for gold and silver and about a 1-to-1 for Bitcoin. So your risk return ratio for gold and silver has certainly been favorable over that time, even if you have a higher absolute return for Bitcoin. So there's some real good things some things to like since we made this recommendation. And as we're going to talk about, going with your AI theme, there's some real reasons to like these trades going forward. We're at all-time highs, and I believe inflation adjusted highs for gold as well. But there's reasons to like these going forward.
Well, I think so in the longer run, but also there's some misconceptions around this, and I was thinking long and hard on, how could these two themes be related, AI and gold and silver, and clearly, the first thing to think about is kind of monetary and fiscal policy, because we're in the markets where everything is driven by either monetary or fiscal policy, essentially, and of course they're related through that. I mean, there's no real no, I found some articles. I'll share my screen. I found an interesting article on Seeking Alpha about how basically AI revolution will make gold and silver skyrocket, because this article makes a couple of interesting points, right? Fairly obvious, I think. Obvious, but I think misleading. First, it says that industrial uses, right? Just like silver, gold and silver have industrial use, which is absolutely true. Silver has a massive number of industrial uses in general in kind of semiconductor era. Silver is in short supply, absolutely so. We pointed it out. Our biggest, even though we have a quant slash financial advisor channel, our biggest videos are in gold and silver because that interests people a lot. But also the article says that gold and silver are both hedges against money printing, and money printing likely caused by the AI boom. Now, of course, it's not caused by the AI boom. It might be the other way around, if anything, right? AI boom is caused, basically money printing creates extra capacity, right? And then
Right.
here I want to share an interesting article where, again, going back to this theme of the bubble in AI, and then we'll get to gold and silver, basically says that right now AI machines are saving the US economy, which is essentially means that the massive investment of 500 billion or 600 billion investment is saving the economy. Now, projection for that investment is to go to trillion, close to trillion, and then 3 trillion over the next few years. But what's interesting, the Bain analyst here said that AI won't be able to generate enough revenue to sustain the computing power it needs to build. And here I think it's important to note that we're seeing very similar themes as we saw around the internet, which was also kind of a bubble and kind of not, because it's changed the economy. But the main theme on the internet was that even after 2000, people kept saying that, how will Amazon ever recover this investment? They looked at it and said, "Well, what is there unique about Amazon? It just ships products from a warehouse. It doesn't have any unique technology.
Yeah.
Why are they losing so much money to build this business?" Same thing with Facebook. They said, well, Facebook, I mean, those companies were losing money for close to a decade. People said, how are they going to recoup this investment? What are they going to do? Because Facebook is a free service, and if they ever start extracting money from people, they will leave and they will move to a competitor. What I think those people miss in the technology space is that the monopolistic power in the digital age is unprecedented, just unprecedented. And you don't have to be an explicit monopoly to exercise it. You can exercise it by acquiring competitors. You can exercise it by poisoning the well of technology, as Microsoft did many times. There's lots of ways to exercise your leading position. So all these companies are investing hundreds of billions of dollars to people who do regular kind of spreadsheet ROI calculation from the past, when you were running like a car maker company, and different laws of economics work. You basically said they're not never going to recoup it. But the problem is that with that reasoning is that when they become monopolies, and OpenAI, it doesn't have to be that OpenAI is the only company to be a monopoly, right? To be fair, you can have OpenAI, you can have Grok, they can be monopolies in different areas of the market. Once they become monopolies, kind of like Facebook did in some sense, right? Even though they're not the only social network, you can extract all that money. I am certain they're going to extract all that money back from us. And I'm not saying it's good or bad. I'm just saying realistically, look, if Amazon, which ships like sneakers and electronics, was able to extract all that money, then a company, look at the research that I cited in my previous video, where according to MIT study, close to 90% of people use these things at work. And actually, half of that 90% use it in a stealth mode, meaning that it's unapproved by their company. Now,
Interesting.
Amazon never had power like that. Think of a power where, whether when you're selling sneakers or electronics or something, and I don't want to belittle Amazon in that way, but it is what it is, to a power that you have of a person whose livelihood depends on it. It's not about buying a cheaper iPhone or cheaper gadget. It's about my job now depends on it. So OpenAI at some point soon can easily double their prices, and those people will not leave. They will not, because if you're making, thousands of dollars a month with this tool and it's central to your job, you will pay $20, you will pay 40, you will pay 200. And then I'm not even
Hang on a
mentioning
second
all
there,
these
though.
other ways. Yeah.
But this goes back to your monopoly point because there's things like Claude, there's things like Grok. I mean, so how much pricing power does one of these have when there's three or four choices right now? Because I think that there's still not, I mean, maybe this is way down the road, like you said, because nobody was doing what Amazon was doing. I mean, they were selling books, right? I mean, they were selling books online, and we had a couple things that were trying to do this. But what Amazon was able to do is they were able to move into these they were able to just become this like ubiquitous, service that sold everything, which was what Walmart was in every town. Like they had the brick and mortar stuff. So to do something that's technologically this advanced, but everybody's, there's so much money being thrown at it, being monopolistic might be a little bit more difficult. I mean, I agree with what you mean by Facebook. It's a social network, but this is information. This is a little bit different. This isn't where you need people to gather. So it's a little bit different, I
Yeah,
think,
I
because
think that
yeah,
it's the same because even in Facebook case, right, there was YouTube and there was then later Instagram, which they bought. There were other social media. And when Facebook started doing basically monopolistic stuff, right, they limited your reach of your page. Now you have to pay to reach your subscribers. They've done all these kinds of things. People could say, well, why wouldn't you leave to YouTube? But the problem is that you're also OpenAI and Grok, they will build slightly different competencies. So it really will be different like Facebook and YouTube. There will be somewhat different models, good for different uses. But then they're going to build, social media had your network. They're going to build internal tools in OpenAI that you're used to. It will know more about your job. It will know more about you. So there's going to be some investment from you into the, let's say, OpenAI account that they will use to keep you there. So the switching costs will be higher. And plus, ultimately, I think the game theory will dictate to them that they're all going to raise their prices at some point. Because I don't think it's going to make any sense for one of these companies to keep losing money beyond certain point when they can now make money. So I think ultimately, and there's this a guy, former minister of Greece for finance, Yanis Varoufakis, right? He has an interesting theory of techno feudalism. He basically says we're beyond capitalism, but we're back to feudalism in the digital age where there are different feudal lords and they have different fiats, right? Which is like Elon Musk has his own fiat, Sam Altman has his own fiat, and they're fighting for a bigger fiat. But it doesn't mean that people living in that fiat will be very easily able to arbitrage between them. They're not so stupid, in other words, right? So now I don't completely agree with this theory, but I think it has a lot of merit on some level to analyze this. I think it's much better to analyze what they do in terms of fiats, in terms of feudalism, rather than straight capitalism, because capitalism really has certain rules where it really does not make sense. Now, in fact, under capitalism, even if Facebook didn't make sense, there was so much money lost, such a high risk of competition. What the people didn't understand is that they're going to continue to get free money or cheap money. They're going to continue to expand and ultimately become a monopoly, and then they'll be able to extract all of this. And I fully expect that this will happen with AI, except much, much faster. I mean, AI is already adopted twice as fast. Again, I'm not saying this is all good. It's just, I think reality is that people who try to understand using a snapshot, like here we are today, how are they going to extract this money? What they don't understand is, first of all, the technology will get a lot cheaper, just like for Facebook. The cost of running Facebook became, well, they invested more and more, but if you take the same hardware, the same services, they become cheaper and cheaper and cheaper over time. So their costs went down. Same thing will happen with AI if you invest so much money in the infrastructure. So I think that this is static analysis. It assumes a slow moving world. Now, in a slow moving world, like in 1930s or even 1960s, I think it's a fair analysis. But now we're living in a world where in 2 years, we're doing a lot of different, and again, I don't think it's necessarily great. So I think AI boom, if you analyze it down to its logical conclusion, to the fiats, to the monopolies, they're going to extract all that money and then some, and all that investment is worth it. Now, is it worth it For humanity, I would agree not, because we're going to get a lot of poison water. We're going to get rising electricity bills. We're going to get all kinds of problems
There's all
from,
kinds of
we're going to lose jobs unnecessarily. Sometimes I think that AI will make a lot of people lose jobs, but not quite in the way people think. What people don't understand is they say, yeah, but and I've heard this, they're not going to fire all the customer service because AI is not going to do it as well. Well, guess what? If everybody does it and customer service becomes poor, I mean inferior quality, and all corporations get a 10% boost to their bottom line, do you think they're going to sit there and say, you know what? No, I'm not going to do it. That's not going to happen, unfortunately. They
right.
are going to do it at the cost of reducing quality. Now, people argue with that because they, well, AI is not so good. Yes, it is not so good in some areas, but it's exceedingly scalable at zero marginal cost, and it is good enough, especially if they all do it together. This is game theory. I recommend. We're living in a world where game theory is paramount, where game theory is where essentially you're playing a collective game. Now, we're playing a collective game. Also, Elon Musk, Sam Altman, Satya Nadella, whomever, they're also playing a collective game. And in that collective game, they don't necessarily communicate directly. Now, they probably do, but maybe they don't. It's not necessary for them to agree on this. It's just logic that will drive them to this. So I think that what
And you're talking about the state of the world today. I mean, it's going to get better. So you talk about like, I mean, even if they cut it off today, I mean, they're going to say, okay, we're going to get 10% of our bottom line. This is good enough for now, and it's going to get better. I mean, it's going to keep on getting better and better and better, and eventually it's going to be good enough. And you're going to forget about just like we forget about. I mean, we can complain about the call centers that we have to go to, overseas, every time we call somewhere, but that's what we do now. That we don't have big American call centers with people sitting there answering phones anymore. Sometimes you get them, but most of the time you're not. You're getting people
yeah.
overseas, and that's just what you get. And you've come to expect it, and you're frustrated. But what are you going to do? There's nothing that you can do. So to your point, though, a lot of this AI boom, it requires new technology, new like there is a cost to doing it. There's a cost to rolling out the new technology. There's a cost to rolling out the new chips, and some of that is money, like cash money, printed money, what have you. But it's also the technology, as that chart that you or the article that you just had brought up. Silver is used in some of this, gold's used in some of it. Now I don't know to what extent, how much, but and I doubt that it's the biggest thing that's used in these things, but there is still going to be some demand on that, in addition to the inflationary properties, in addition to being a hedge against the monetary printing that's going to take place. So there's still likely to be a demand and undercurrent to gold and silver in the future, even though we're at all-time highs. I think that's one of the things that we're hypothesizing here.
Yeah, I agree in the long term, absolutely gold and silver. We're living in the final stages of this monetary system, no doubt. Now, the problem with this thinking, even from my side, that I have to caution myself is that historically speaking, final stage could last 10 years.
Yeah.
And it's not a very long period for history. I think that the first point we established is that I think that measuring AI boom in the old kind of way with static analysis is wrong. But also, I think that this article that I brought up, I'm sure it's a good article, but I think it's a mistake to try to look at supply of silver and gold, and even though it is actually crucial. Silver is absolutely crucial. With gold is used less, but in the end, right, the gold and silver are money, and that's what we're seeing right now. Because even if you look at the supply, the use of gold and silver. Even if you look at that London chart that you showed, there's absolutely no. If let's look at London Vault as a proxy for supply. Now I know that that's kind of very simplistic, but it is kind of a supply, right? It's related. So supply dwindles. You could see that the price wasn't growing as much. Then supply was flat. It was exploding. Now you can see at the end, last few months, supply is actually rising. There's more gold and silver in these vaults. The price is skyrocketing even further.
Yeah.
I
Right.
think that what drives these metals is the monetary use. I think the monetary use is so much bigger than any real production today. People remember in the 90s, 2000s said the software is eating the world. Now it's the Fed that ate the world. It swallowed the world whole, and we're like basically monetary policy drives everything. And so to say that the supply, because AI investment boom will accelerate, the supply of silver is really going to make a difference, I don't think so. I tend to think that, in fact, AI investment boom may create a lot of deflationary effects, and that may not be great for gold and silver in the short run. I still hold it. I would hold it for the long run because I believe in the end of the system, that's probably going to be the money. That's going to be the real money that's going to be left, right? The digital money will not be fully real money. The central bank digital currencies, whether in the stable coin format or in the actual explicit format, the fiat will probably be debased because it has to be debased. The debt load is incredible. So
Yeah.
it will be money. But in the short run, I would actually forget about thinking about the supply of silver for industrial use, even though it's very important. But compared to the monetary trends, and when people buy silver, clearly they buy it not because it's used in chips now. That's very stable. The price didn't go from 19 to 43
Right.
because
Because of the chip. Yeah. Yeah. Of course.
and also it's important to know that static analysis is wrong here too, because as silver goes up, it's going to be replaced by other things. That's how
Yeah. I mean,
technologies
there's
work.
also the dollar, I mean, it's a, I mean, it's priced in dollars, dollars decrease. I mean, there's a big component of that. And there's a lot more than what we're talking about. I mean, we're kind of like really oversimplifying things, but
Yeah. And in the closing, I'd like to run a couple of stress tests. I'm gonna use our stress test AI. Actually, it's kind of pulling the whole thing together because it's built with traditional math, but also with AI. And I'm gonna have a very unique portfolio. It's gonna have Bitcoin, gold, Nasdaq, and silver. So we're bringing kind of all themes together here. And you see that I'm showing you this app stress test AI. This is our risk
is that
application.
just your portfolio right there, Daniel? Bitcoin, gold, NASDAQ, and silver. Is that
Yeah,
just what
it's
you
on the
hold?
left here. Can you see my screen?
Yeah, no, I was kidding. I was making, is that your personal
Yeah.
portfolio right there? Yeah.
No, well, actually, let's leave that unsaid.
No,
So
joking.
you see in the middle, these are different stress tests. So we're saying, okay, with this portfolio, the stress testing tool, we're using the same kind of stress test that, let's say, large asset managers use, or even the Fed for the banks. In fact, for those that don't know, me and Jan, we designed a lot of these stress testing algorithms that are used by top investment firms right now. The first scientific article I wrote on the new stress testing methods was 2007, clearly because it became very useful in the crisis. But anyway, so I want to try a couple of scenarios. Here we have scenarios like inflation, stocks up 30. By the way, scenario Israel attacks Iran, which we had before the event, it actually proved to be fairly correct. The market is up about that amount since then. Now, it doesn't mean that we forecasted it, because stress testing is not about predicting future. It's about looking at plausible scenarios, even opposite ones. So I'm going to look at a couple. Let's look first at the AI bubble burst scenario. So in the stress test AI, you can just type it like that. That's why I love playing with this. It's gonna use our multi-factor model, which has over 1,000 factors in there, and it's gonna design a scenario so you don't have to be like a super trained risk manager, which you used to have to be. Actually, very interesting picture that it generated for fun. Um, I'm gonna look at this scenario. So it says that uh, semiconductor, it has it dropping 86%. Now, if you look at this, now you see why people are screaming about this bubble, how dangerous it is. Now, I think 86% may be excessive, but we're doing a stress test. Software is down 37%. United States market total 22%, and then biotech is down. Okay. Now we can look at the explanation here,
I want to see why it's
and
doing
I'm not going to
biotech.
read all of it.
I want to see why it's stressing biotech.
Yeah. Well, interesting. It says while it has some exposure to AI and drug discovery, it's less directly tied. So it added as an indirect impact. Interesting. But the other three, there's an analysis. So stress test AI gives us explanation of why. I'm not going to edit this scenario, but you can. It also gives us all the research, or part of the research that it's used to come up with this. So
Well, one of the
normally
things
a
that,
risk manager would take like probably a few days to come up with such a scenario. It does that pretty quickly. So
one of the things
AI
that
bubble burst.
it can
Yep.
do is if you, yeah, go ahead and apply it while we're talking, but because one of the things that it can do is every factor is stressed when you do something. So you have something like that, semiconductor factor. One of the things that can happen is that maybe the biotech factor is also down, just based on the correlation, down like 60%. So one of the reasons, if you put it, it has some exposure, but it's not going to suffer that much, that could be like a control factor almost. Like it's not going to suffer like the other factors because it's not as reliant. And so that's almost a control factor of putting it in there. And that could be what it's saying. It's the natural state of the biotech factor, if you stress a factor like that, could be down 70% or something like that. But what the model is saying is we don't believe that something like biotech is going to suffer in
Yeah,
that way.
that basically it's saying that the contagion of it to other tech sectors will be limited, right? And
Yeah.
again, stress testing is not about prediction. It's
Right.
about plausible scenarios that you run to try different to find flaws in your reasoning, to find vulnerabilities. So in this case, if I look at AI bubble burst on the right side of the screen, you notice here there are contributors. And what is somewhat surprising to me is that Bitcoin is down almost twice as much as NASDAQ. Because remember, we have equal weights, but it's contributing. So overall portfolio loss is 33.7%, 33.8. And Bitcoin is contributing like over half of that. Whereas NASDAQ a lot less, and silver and gold holds up really, really well. So um, that's what the multi-factor model. I'm not saying that's the only outcome, but I think that the way our model is designed, it ingests a lot of data. It's not just AI. There's actually a multi-factor old quant type of model and then AI overlay. It's suggesting that Bitcoin will suffer massively. And it's interesting that over the last few days, and again, this is not proving anything, but we have seen something strange that there was some talk of a bubble burst, and we see problems in Argentina and then with subprime lenders in US, and Bitcoin has reacted violently down. So all of a sudden, it lost all of its risk kind of protection properties, and our model seems to indicate that if there was really a bubble burst, it would be problematic. Now let's try another scenario real quick. By the way, you can request a free trial of the software, Stress Test AI, and you can play with your portfolio and you don't have to pay anything for a month. So I'm gonna say AI investment boom accelerate. Let's see the opposite case. Okay, got a kind of a fun looking illustration that you could use in your presentations and so on. And what it's saying here is now S&P technology hardware is up 1.5 standard deviation, 34%. Computers are up. But what's interesting is that saying that the corporate European spreads are up. That's like that's unexpected to me, right? So if I go here and we look at the explanation, you see it gives you the analysis of the stress test that you could use in a meeting and so on. I'm sure lots of people already would want to use something like that for for their job. But it's pretty clear with these three factors. But what it's saying is that a high risk bonds when you see widening spreads, if market sentiment is affected by fears of AI driven economic correction. What is it talking about here? It's talking about the deflation that I spoke about earlier, the correction that comes from kind of really the demand side, right? Meaning people being fired massively. If investment boom accelerates, lots of people being fired, that will mean an economic recession in its own right. That way, AI could sort of decouple in that it's getting money from the banks, from the central banks. It continues to do the investment, and more people lose their jobs. But there's an economic recession because of that. So I think that's very perceptive. Whatever this model, whatever it got this idea from all this research that it gathers, I think it's plausible, right? Again, not the only scenario, not a prediction, but a plausible scenario that we could look at. And if I look at AI investment boom accelerates, you see that surprisingly the effect on the portfolio is muted. Nasdaq is up, right? It gives 40%, 4%. Now, it doesn't mean Nasdaq is up 4%. That's a 4% contribution. So really it's 16% because quarter of the portfolio. Bitcoin is up somewhat from here, but interesting that the multi-factor model we have here on disagrees with the premise of the Seeking Alpha article. It doesn't agree that gold and silver will be up massively in the investment boom scenario. And I think that is because of that corporate spread factor, because it is risk factor that is related. I think that what we're seeing here, right, and we're seeing again that gold and silver are down a little bit. What the model is suggesting is that it's looking at the factors that will say that we have a deflationary type of event, that rather than being inflationary, this could actually end up in deflation. Lots of people fired, they lose their jobs, and deflation. While gold and silver do okay in deflation too, But given the sentiment now that everybody expects massive inflation, which will come down the line, maybe after deflation, I don't know. I think if there's a deflationary turn, gold and silver would
Yeah.
suffer severely. So I think that this combined analysis suggests that it's not so simple. The simple thought would be that, hey, we have gold and silver at all-time highs. We actually said that it's almost, it's very, very plausible they will be. AI investment boom is here. People talk of bubble. But if AI investment boom accelerates, it seems very plausible from even the logic that I showed you in that article that gold and silver will keep blowing up. But what people don't, again, this is the example of that static analysis. They're looking at a situation as it is now and applying something to it. But you should look at the fluid situation. If there's another $1 trillion of investment in AI, how many jobs will be lost?
Right.
How will that impact inflation? How will that impact gold and silver? I think the impact could be quite opposite from what people expect. And so this is an important note. I'm a fan of gold and silver, but the reality is that I think that AI is becoming the driver in the market, right? In addition to the Fed or enabled by the Fed, so. And what happens is that the technology will have such repercussions that will change some of the relationships that we expect. And I would sort of close my thoughts on that note.
Yeah, no, I just think it's interesting because we didn't talk a lot about the dollar. And when I see something like that, I'm wondering what the currency effect is, underneath all that with that stress test too, because, that could really be a currency effect. It was pretty muted, but I'm also wondering what the dollar does in a situation where you have this boom, because for the last, bunch of years, we've had a pretty strong dollar until this year. And so I'm just
Yeah.
wondering, like, historically speaking, what the model thinks that the dollar is going to do in that situation. So
Well, I think that that's actually a great topic for the next video. I think write in the comments if you think that the dollar is an interesting topic in relation to AI and gold or whatever other topic you're interested in. My thought is that dollar will be strong in that scenario. Deflationary scenarios, loss of job scenario will drive some. I think, despite the long-term debt situation and so on, the short-term event will be dollar strength, but that's separate discussion, and I can dig up some data and do some stress tests on that too.
great. Well, great. Thanks, Daniel. Thank you for listening,
Thank you,
and
Jan.
we'll see you next time.
Thank you for, yeah. Write in the comments whether you agree, disagree, what's wrong with our reasoning, and we'll see you soon. Bye.